So here we have another situation on how to become your own bank. You have John here who buys a $100,000 life insurance policy, and 20 days later he takes out 90% of that life insurance policy. John goes to the car dealership because John wants to buy his dream car. So John makes a deal with Lisa and gets his dream car and pays $90,000 cash for his dream car. John then pays the family bank over the next 60 months what he would pay to a traditional bank and pays the $90,000 back to his life insurance policy. At the end of it, John ends up with his dream car, and John ends up with his $100,000 life insurance policy. The entire time, the $100,000 life insurance policy, even though he took out $90,000, the full principal amount on the $100,000 had been compounding. The interest had been compounding around between 3 and 5%. Then you have Fred here who uses $90,000 from a bank loan from a traditional bank to purchase his car. 60 months later, the bank loan's paid off. Fred has used all that money and paid that interest to the traditional bank. And at the end of it, Fred only owns his car. Now, you can use Be Your Own Bank, Infinite Banking, or learning how to be your own bank for multiple different purposes. But let me know what you'd like to see next in the comments. Excited to hear from you.